Hi all, welcome to i-tutor Academy. In today's session, we will start with Unit 8 of MMPC 010, that is short run cost analysis. So, objective of these units are after going through this unit, you should be able to understand some of the cost concept that are frequently used in the managerial decision making process, understand short run cost function, understand application of short run cost function in managerial decision making. And structure of this unit are: there is an introduction, actual cost and opportunity cost, explicit implicit cost, accounting cost and economic cost, direct cost and indirect cost, total cost, average cost and marginal cost, fixed and variable cost, short run and long run cost, short run cost function, application of short run cost analysis summary, and self assessment questions, and all. Okay, so let's begin with the introduction part. So the analysis of costs is important in the study of managerial economics because it provides a basis for two important decisions made by managers. One is whether to produce or not, and how much to produce when a decision is taken to produce. There are two type of cost analysis: short run cost analysis and long run cost analysis. Okay, so in this unit, we shall discuss some important cost concepts that are relevant for managerial decision. We analyze the basic difference between this cost concept and also examine how accountants and economists differ on treating different cost concept. We shall discuss short run cost function and its application in managerial decision making. The short run cost estimate is helpful to managers in arriving at the optimal mix of input to achieve a particular output target of a firm. And next is actual cost and the opportunity cost. What is actual cost? Actual cost are those costs which a firm incur while producing or acquiring a good or service, like raw material, labor, rent, etc. Okay, so economists call this cost as accounting cost because traditionally accounts have been primarily connected with the collection of historical data in reporting a firm's financial position and in calculating its taxes. Sometimes the actual costs are also called acquisition cost or outlay cost. And on the other hand, opportunity cost is defined as the value of a resource in the next best use. Okay, and one may ask you that whether this opportunity cost is really meaningful in the decision making process. Opportunity cost can be similarly defined for other factors of the production. Okay, and example is here. Please go through your study material. And next is explicit and implicit cost. What is explicit and implicit cost? Explicit cost are those costs that involves an actual payment to other parties. So therefore an explicit cost is monetary payment made by a firm for use of an input owned or controlled by others. And the explicit costs are also referred to as the accounting cost. So example is here, you can go through from your study material. On the other hand, implicit costs represent the value of foregone opportunities but do not involve an actual cash payment. Therefore an implicit cost is the opportunity cost of using resources that are owned or controlled by the owners of the firm. Implicit costs are just as important as explicit costs but are sometimes neglected because they are not as obvious. The implicit cost is the foregone return the owner of the firm could have received had they used their own resources in their best alternative use rather than using the resources for their own firm's production. Example is here. You can go through your study material. This implicit cost generally is not reflected in accounting statement, but rational decision making required that it is to be considered. And next is accounting cost and economic cost. For a long time, there has been a considerable disagreement among economists and accountants on how cost should be treated. And the reason for the difference of opinion is that the two groups want to use the cost data for dissimilar purpose. And accounts always have been concerned with the firm's financial statement, and accounts tended to take a retrospective look at firms in finances because they keep trace of asset and liability and evaluate the past performance. And accounting costs are useful for managing taxation need as well as to calculate profit or loss of the firm. And on the other hand, economists take forward looking view of the fame. They are concerned with what is the expected to be in the future and how the fame might be able to rearrange its resources to lower its cost and improve its profitability. And they must therefore be concerned with opportunity cost, and since the only cost that matters for business decision are the future cost, it is the economic costs that are used for decision making, and accounts and economists both include explicit costs in their calculation. For accounts, explicit costs are important because they involve direct payment made by a firm. These explicit costs are also important for economists as well, because the cost of wages and material represent money that could be useful elsewhere. And accountants and economists use the term profit differently. Accounting profit are the same total revenue less its explicit cost, but economists define profit differently. Economic profit are total revenue less all cost, and the economist takes into account the implicit in addition to explicit cost in order to retain resource in the given line of production. Therefore, when an economist says that a firm is just covering its cost, it is mean that all explicit and implicit costs are being met, and that the entrepreneur is receiving a return just large enough to retain his or her talent in the present line of production. If a firm's total receipt exceed all its economic cost, the residual accruing to the entrepreneur is called an economic profit or pure profit. An example of economic profit and accounting profit is here. Please go through your study material, and this is MMPC 010 unit 8. Okay, so you will get more idea. This is an example. And controllable and non-controllable cost. So controllable costs are those which are capable of being controlled or regulated by executive vigilance, and therefore can be used for assessing executive efficiency. And non-controllable costs are those which cannot be subjected to administrative control and supervision. Most of the costs are controllable, except of course those due to obsolescence and depreciation. The level at which such a control can be exercised, however, differs. Some costs, like capital costs, are not controllable at factories shop level, but inventory cost can be controlled at the shop level. Out of pocket cost and book cost. Out of pocket costs are those costs that improve current cash payment to outsider. An example, wages and salaries paid to the employee are out of pocket cost. Other example of out of pocket cost are payment of rent, interest, transport charges, etc. On the other hand, book cost are those business costs which do not involve any cash payment, but for them a provision is made in the books of account to include them in profit and loss account and take tax advantage. Example also here. Past and future cost. So past costs are actual costs incurred in the past, and they are always contained in the income statement. Their measurement is essentially a record keeping activity. These costs can only be observed and evaluated in retrospect. If they are regarded as excessive, management can indulge in post-mortem checks to find out the factors responsible for the excessive cost, if any, and take corrective action for future. Past costs served as the basis for projecting future cost. And future costs are those costs that are likely to be incurred in future period. So since the future is uncertain, these costs have to be estimated and cannot be expected to be absolutely correct figure. So in period of inflation and deflation, the two cost concept differ significantly, and managerial decisions are forward looking, and therefore they require estimate of future cost. Unlike the past cost, future costs are subject to management control, and they can be planned for avoided. Management need to estimate future costs for a variety of reasons, such as expense control pricing, projecting future profit, and capital budgeting decision. When historical costs are used instead of explicit projection, the assumption is made that future cost will be the same as past cost. So in period of significant price variation, such an assumption may lead to wrong managerial decisions. And next is historical and replacement cost. The historical cost of an asset is the actual cost incurred at the time the asset was originally acquired. In contrast to this, replacement cost is the cost which will have to be incurred if that asset is purchased now. So, the difference between the historical and replacement cost resulted from the price change over time. Okay, so here is an example. Please go through it. And private cost and social cost. So, in further distinction that is useful to make, especially in the public sector, is between private and social cost. Private costs are those that accrue directly to the individuals or firms engaged in relevant activity. Social costs, on the other hand, are passed on to the person not involved in the activity in any direct way. Consider the case of a manufacturer located on the bank of a river who dumps the waste into water rather than disposing it of sometime the other manner. While the private cost to the fame of dumping is zero, so it is definitely harmful to the society. It affects adversely the people located down current and they incur higher cost in terms of treating the water for their use or having to travel a great deal to fetch potable water. And if these external costs were included in the production cost of a producing fame, a true picture of real or social cost of the input would be obtained. Ignoring external cost may lead to an inefficient and desirable allocation of resource in society. And relevant cost and irrelevant cost. The relevant cost for decision making purpose are those costs which are incurred as a result of the decision under consideration. The relevant costs are also referred to as the incremental cost, costs that have been incurred already and costs that will be incurred in the future, regardless of the present decision are irrelevant cost as far as the current decision problem is concerned. And there are three main categories of relevant or incremental cost. These are the present period explicit cost, the opportunity cost implicitly involved in the decision, and the future cost implications that flow from the decision. An example is here. And also, if there is any expenditure on the capital equipment incurred as a result of such a decision, it should be included in full, notwithstanding that the equipment may have a useful life remaining after the present decision has been carried out. Thus, the incremental cost of a decision to increase output level will include all present period explicit cost which will be incurred as a consequences of this decision, and it will exclude any present period explicit cost that will be incurred regardless of the present decision. And the opportunity cost of a resource under use discussed earlier become a relevant cost while arriving at the economic profit of the firm. And many decisions will have implication for future cost, and both explicit and implicit. If a firm expect to incur some cost in future as a consequences of the present analysis, such a future cost should be included in the present value terms if known as for certain. And next is sunk cost and incremental cost. Sunk costs are expenditure that have been made in the past or must be paid in the future as part of a contractual agreement or previous decision. An example, the money already paid for machinery, equipment, inventory, and future rental payment on a warehouse that must be paid as part of long-term lease agreement and or sunk cost. Okay. And in general, the sunk costs are not relevant to economic decision. Okay, so example is here, you can read it out from your study material. And on the other hand, incremental cost refers to total addition cost of implementing a managerial decision, change in product line, change in output level, adding or replacing a machine, changing distribution channel, etc. are example of incremental cost. Sometimes incremental costs are also called as avoidable or escapable cost. Moreover, since incremental cost may also be regarded as the difference in the total cost resulting from a contemplated change, they are also called differential cost. As stated earlier, sunk costs are irrelevant for decision making as they do not vary with the changes contemplated for future by the management. It is the incremental cost which are important for decision making purpose. Okay, so activity 1 is here from this section, and please go through it. If you can do it. And any doubts, you can contact us anytime. So this is about today's section. Next subsections we will discuss on next video. And for more MBA series, you just do like, share, and subscribe our channel. Thank you so much.
i-tutor Academy presents IGNOUMBA Complete Syllabus Coverage Classes for individual students, semester-wise subject with online flexible timing. For more details, contact on +91 623 827 1885.